silver has made a grand mistake. That's what we're arguing. Markets make errors. Anybody who's been in markets long enough knows that, hey, that dot-com top, that was an error. It went too far, too long, and therefore it broke. NASDAQ dropped 82% in the next 2 years, 82% after that bubble broke. Because it was why? Nothing wrong with the truth of the internet. It changed our lives. But they overpriced it too quick and it burst.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with Michael Oliver of Momentum Structural Analysis. We're going to discuss gold, silver, platinum, and ask him the questions that you submitted. Michael, thank you for coming back on the show.
Good to be back, Steve.
Great to have you, sir. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Oh, golly gee. Okay. I think the stock market is illusory. I think it is a bubble. We measure it not by the price action, but by long-term momentum. And let me put it this way. In January of 2000, MSA said, be gone. Okay. This is the dot-com top. S&P then in January dropped for the next month or two and turned around and went up and made a new high. Okay. Marginal. And it just sort of fiddled around slightly above what had been the high in January. And it waddled sideways for the whole year. Meanwhile, it felt comfy because you were above our January get out point. It didn't really go anywhere, but it made a new high in price. Momentum did not make a new high. Okay. Momentum had broken the backbone of the dot-com bubble uptrend on momentum in January. Price didn't get the message for a while. And it fooled people because it felt comfortable. Finally, in 2001, it started to really fall apart. Okay. The same thing happened in 2007. In late 2006, the last report we put out that year, we projected that the S&P would rally up to, again, 2006, and we projected it would rally up to 1550 plus on the S&P. Well, what was that? That was rally back to the high that occurred in 2000, okay? So we said it would probably go up and take that out. Well, they went up in early 2007 and hit that level, and they sold into it. In other words, they sold the old high in the year 2000. Momentum already said you're no good at that point. Okay. The price said, oh, look at me. You had a little drop because the guys sold the old high, the 2000 high, the 2007 high at 1550 price level. They made a little money, but then it came back up in August, September, October, and in September of 2008, moving back up toward that 1550 level again, the Fed cut rates. Surprise, it was a party. They didn't expect it. You shot up into October and you took out the high of early 2007, which was again 1550 area, the high in 2000, which was 1550 area. So you had what was called a double top breakout or a triple top breakout. Took out two prior highs. What could be more impressive on a price chart than to have a high and a high 7 years apart and then take them out? And that's the top. It topped right there. It topped at 1575, which late in 2006 we projected it would peak between 1550 and 1600. It waddled off. It didn't crash right away or anything like that. I mean, it went down for a whole year before you finally got a bloody month. It was October 2008. But anyway, that's the type of behavior, laborious behavior, that you get when you make a high, break momentum, because in January of this year, we were at all-time highs in S&P and NASDAQ, marginally above the 14 highs. Yeah, there you go. And then you had your sharp drop. Unfortunately, it was news-related. And usually news-related sell-offs don't work. They reverse. We'd gotten bearish in January, way up just off that high. And it took it a while, Feb, March. Finally, in March and April, it fell apart. And it hit a level we said there's likely to be a bounce point at 4,800. Well, look at the price chart. It stopped on top of that old high of 2021. So the guys with crayons drew a line across and said, I'm going to buy it there. Mm-hmm. It worked. Okay, fine. The problem was that break broke the integrity of the momentum uptrend that had already been underway since the 2022 low. And the rally to new price highs was not confirmed by momentum. In fact, if you saw a momentum chart of that, a long-term momentum chart, you'd see that that entire rally is up under the breakage point that occurred in January. So momentum is totally deviant from that chart. We do not trust this rally. We think it is a teasing new high, which is by about 10% above the January high, which was 61.47 in January. Right now we're trading what, 6,600. It wouldn't take a lot of a drop to get back to that January, February high early this year. And if you ever do that, the price guys are going to say, well, hey, I thought this was a rocket launch. Why are we doing back on the launch pad? Okay.
Yeah.
They'll get concerned. Momentum already says don't trust the rally. Okay. So that's what I think of the stock market. I think we're making a broad, major top of a massive bubble market that is both the oldest bubble market in US history, 16 years of upside with corrective declines, not bear markets. These are all like 20% or less declines. Um, and momentum says it's over. Price says, oh, I'm still here. Well, we'll see. Okay. Uh, it's also the biggest multiple gain in the stock market over that such span of time. The 29 bull top was nowhere near the multiple gain that we've seen since 2009. And if you look at an M2 chart or look at a Fed funds rate chart, you'll know why we've been on drugs for
There's the
15.
M2.
I mean, yeah, I mean, Cheech and Chong chart, inhale and enjoy. Okay. The money goes somewhere, it went into the stock market, which is actually not really true. If you do the real math on that chart that you just showed, the M2, the growth rate, if you go back to 2000 with the dot-com top in the S&P, S&P then was 1550. Okay. It's now 25 years later, October 2000 to October 2025. Money supply has grown about 4.6 multiples. S&P's grown about 4.5 multiples. Okay. S&P's only kept up with the decay in the money unit, the real buying power. Meanwhile, gold, if you bought it in October 2000 and are holding it now, you're up 16-fold, triple and more than the S&P, beating the money supply degradation handily. And yet everybody's focused on every uptick and downtick in the S&P. It's up to them, That's what we see. And I think the S&P it won't take much intermediate decline right now, like a failure from the recent highs, let's say, drop another handful of percentage points, or we're going to start triggering some momentum metrics, some shorter term stuff that says, uh-oh, launch is failing. So this fake out launch will be what we argue that it is. The issue then becomes, where does the money go?
Okay, so basically, you answered a whole bunch of questions right here from Bowen, Paradox and Freedom. Basically, you see the stock market is generally going to be a loser. I'm going to try to emphasize your point here with the charts. If we go here to the S&P 500, we take the dot-com bubble around 2000 here, and we just look at percentage returns. We'll run this up. We're north of 300%. Now, if we do the same thing for the spot price
That's
of
for
gold,
fourfold then. Okay, 300%. Yeah, okay.
yeah,
Yeah,
fourfold.
okay. And
We
go
do the same
to
thing for the
October of 2000, October. Well, anywhere in there, gold was just dead sideways in that time. So where was gold then?
like $250.
Okay, well,
1,500%.
Yeah, okay. Yeah, okay. So, and yes, they're big bear markets in gold. They've been pulled, but in stock market too. Since the year 2000, we've had a bear market, 2007 to 9. We had a sharp correction in 2021 to 22. And yet, they persist over that investment time span. But which one did better? There's no debate. There's
Yes,
zero debate.
this
And
one
yet,
did almost
and yet,
5 times as good.
yeah,
Yeah.
but nobody pays attention to that. That's fine. They'll start paying attention, and by the time they do, that's fine with me because they'll goose the gold market off the page. But anyway,
Okay, the Paradox wants to know, do you see a possible blow-off top happening like 1999 in the NASDAQ?
yeah, a lot of people. What's so funny is there's a lot of professional fundamental analysts that I tend to respect who have been skeptical on the stock market since late 2024, early 2025, and it started to break and they felt like, see, we were right. Okay. But then it came up and made the new high and they thought, golly, gee, I'm stupid. Well, maybe you're not. Maybe it's just process. Okay. Just like 2000 was, 2007. But a lot of these guys have shifted from doubters to suddenly saying, oh no, this beast is going to go crazy. So it's not rational to blow off, but they're saying, well, this is an irrational market, it's going to blow off. Well, there's too many people saying that now. I hear it all the time. I don't know of a blow off I've ever seen that a whole crowd of people thought it was going to blow off. So I suspect even the guys who are doubters who've now done a total switch still don't like the market, but they think it's going to blow off. Even they're going to be proven wrong. And the issue then is emotion. Because right now, the average guy out there has got a retirement account and he's looking at his horizon of his reality of his financials. He's late on his credit cards. He's up to the limit on his credit cards. Mortgage payments are tough, et cetera, et cetera. The only thing that looks good is his retirement account because it's moved up beyond last year's highs, assuming it reflected the S&P, let's say. So that's the only thing he's smiling about. If you take that away from him, emotion comes into play and doubt and uncertainty, panic. Okay, so suddenly things that are calm go dark real quick. And I'm just suggesting that if this stock market rally is going to fizzle and fail, as a fail launch, which I think it will, that's what's going to happen. And then the money will run panic-like. Already big asset managers are making moves. We know that. They've been buying T-bonds lately, and they've been ongoing buying gold and gold miners this year especially. Huge move in gold miners to beat the pants off the stock market, it hardly gets mentioned. Some money's already moving, but once you break the beast, even more money will flow, and they'll look at the horizon and say, okay, what's good? Okay, well, commodities are dead flat. They've been there for 2 years, sideways on the Bloomberg. Nothing going on there yet. We think it's going to turn up. Okay, even, oh golly, Nvidia's slipping. Oh my, if you notice last few days. Watch Bitcoin too, because Bitcoin will be a player in the stock market and it's near precipitous crash type levels by our work, momentum work. So suddenly you can go to darkness real quick and that money's going to rush to some other place. It doesn't all get burned up in the fire. Never does. It always goes somewhere else. And right now, the two alternatives are what? T-bonds and gold. T-bonds have been a dog. And yeah, they're up some the last few weeks. It looks like there's some money coming in there, 60-40 rule. But where's it really going? Monetary metals and their miners. That's about the only place in town.
Okay. Well, let's segue over to that under gold and silver. Let's see, where should we start? How about this one's interesting. You've been pretty vocal about this. Michael forecasts that silver will have a large spike during the next 2 quarters. Historically, such spikes occur at the end of precious metals bull markets. Does that mean you think we're at the late stages of this one?
No, I think there's a different reality we're dealing with here, just like we're dealing with a different type of stock market bubble than we've ever had before. It's not a double or a triple in price over a span of 5 years. It's 16 years of, ninefold or 19-fold in the NASDAQ from its 2009 low I'm talking about now. It's a different game. And I think the problem now is the government debt markets. Because back in 2007 to 9, as the big short guys knew beforehand, a year or two before, it ain't no good because mortgage market's going to have a crisis. Okay? Well, it did. But we're talking about government debt now. Japanese government debt, European, U.S. Treasury bonds. What's going to happen if that turns into it? What if this rally in T-bonds, and we're open to this because we've been looking for a rally in T-bonds as a counter trend move to a stock market drop. Maybe we're starting to see it. But if this rally fizzles again, this is the third rally effort in T-bonds since they puked from 2000 to 2022, 23. You can draw lines sideways on the price chart of long-term T-bond futures or high yields. They stayed up there. The price stayed low. When you look at the price chart, you say, hey, that looks like a base. And it keeps trying to come up out of it, but it can't. Probably because the fundamentals. If this rally doesn't take hold and you start to roll back over, right now, T-bond futures, for example, a D's contract is 118 or something. You've been down in this year, you've been down to 111 area, 111 area. You don't want to go back down right now, much below 116 even. Because if you do, it's telling us that this third effort by momentum to generate a counter trend move of significance is failing. If it fails, you could take T-bonds, plunge them through those recent lows, and have a mini panic, a panic that would affect the central bank and the central government, and create what? Even further money flow into monetary metals because T-bonds aren't also an alternative this time. T-bonds were a place to be in 2000 to 2002. 2007 to 2009, if you own T-bonds, they went up, yields went down. But if it doesn't work this time, then you've got one narrow place to put it. And I think what's going to happen is this crisis that we're about to face, that gold knows is coming, is likely to put gold and silver at new reality levels that's the new reality. In other words, you're not going to go there and collapse back down to $200 gold or $1,000 gold. And that's when we need to look at some of the charts we got. I sent you some log scale of gold and silver.
Yes, sir. And Johnny on the spot, share screen, log scale.
Yeah.
Okay, you can see gold monthly ratio scale since 1975.
Yeah. This is a logarithmic scale ratio. In other words, you go back to 50 years, okay?
Okay.
And the chart below is 50 years of history of silver. Now, look at the gold. Look at the gold. It's been massive upwave ratio-wise. It was an eightfold move from the 76 low to the 1980 high, eightfold gain. Then you went into a plateaued region for decade plus, 2 decades.
Mm-hmm.
Then you had another surge, also an eightfold move from the 2001 low to the 2011 high. Again, 8 times gain from bear low to bull high. Different span in time, but the same dimension. Our bear low, last one was at 1,050 price level in the year 2015. We're only 4 times, fourfold move. If we have another eightfold move, and we certainly have the fundamentals to justify it, gold's going to be over $8,000 an ounce just to replicate the dimensions of those 2 prior moves.
Yeah.
But also, the main point here, though, is look at it's been gaining. Big legs, range. Big leg, range. Look at the silver chart below. The other monetary metal. And by the way, silver does not move with the commodity complex. Its correlation is directly to gold. The only problem is silver will sometimes outperform gold, but overall, as you can see, it has underperformed gold in the sense that we're only just now moving up out of the 50-year range, whereas gold's done it twice. Okay, there is no range.
Yeah.
Only now on the logarithmic scale is silver now saying, hey, I'm out of here. Okay, well, there's a key thing here. We've been going up in silver for a couple of years, and there's one thing we've identified at MSA that everybody can look at a momentum chart or a silver price chart and say, oh, it's a bull trend. No big deal. We know that. It's been underway for a couple of years here, especially since 2022, late 2022, when both monetary metals had a pullback. Since then, it's been up, 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 and beating the S&P during that time, by the way. But something happened in the late phase of that 1979 to 80 move where you went vertical. And also in that bull trend that had already been going up since 2001 through 2011, something happened in the final 6 months or so of that move where suddenly silver just went vertical in a matter of a handful of months, that little part right there. And also in 79 to 80, it went vertical for the last 6 months of that move. I mean, it went, a buck here, and all of a sudden it went from like under $20 to $50 in 6 months.
Yeah.
In the case of 2010, it was in late 2010, something happened there, and we'll show that in a little while, that said, hey, I'm going to go vertical. We're about to have the same situation now that occurred in those two late trend phases where silver went off the page in terms of multiples. In fact, if you analyze the final 6 months or so, a final handful of months of both of those bull trends, and look at the ratio move in price, if we engage in the same way we did then, the next leg up in silver is going to carry you well over 100, or it's going to carry you, if we match the 79 final 6 month dimension move, over 200. And we're going to do it in several quarters. And there's a key factor we're looking at that will signal the onset of that. And that's the silver versus gold spread. I think you've got a chart of that too.
Okay, let me pull that one up. That is silver versus gold spread. New share. Screen 2. Can you see the silver versus gold?
Yeah, okay.
Okay.
Now this goes back 5 years, and these are weekly closes of silver divided into the price of an ounce of gold expressed as a percent. So back in 2020, silver was like 0.9% of the price of gold, and it shot up to 1.5+% the price of gold. That's a big move.
Yeah.
That's like buying a stock at $83 and having it go to 155 in a matter of about 6, 7 months. Okay. So the spread shot up then. Okay. But since that peak in late 2020, early 2021, where silver outperformed gold, over the subsequent years, even though both metals rose in price, silver has lagged gold's performance. And that's why this spread chart has gone down in layers.
Yeah.
And back in April, it was back under 1% again. Well, 1%, if you go back 50 years on the spread, you'll see that is a very low level. And normally, in fact, 20 of the past 50 years, silver's at least been 2% of the price of gold. That's a normal almost. Well, you can see what's happened since April. Silver's been gaining, the spread has been gaining, the top chart there, versus gold. But it's not up to the green line. And the green line is what we're watching. That level, if you take it out, and that's 1.31%. And by the way, we've done this study using monthlies and long-term momentum, but below you'll see a momentum chart of the spread, which is measuring the spread units versus a 40-week average of the spread. And unlike the spread chart, which is still moving up toward the structure, the momentum chart has already hit it.
Yeah.
And it's headed back. Right now, we're higher than that last read of that uptick you see. So a few weeks ago, we hit the breakout point, stopped at it, pulled back, and we're headed toward it again. If momentum upticks much more this week than we already have, and you get up to about 1.25%, again, divide December silver into December gold, expressed as a percent, that momentum breaks out. And you could bet then that shortly thereafter, that spread is going to break out. Okay, so what? This is exactly what happened to gold-silver spread in late 1979, prior to the 6 month explosion. And it happened in September, October of 2010, when silver was in the $20 range, upper 20s, and it went to 50 by April 2011. What told you that it was going to accelerate was not that it was already in an uptrend, because it already was, no big deal. The spread said, I'm going to blow my cork. And during that final 6 months, what happened? Silver and gold both exploded, but silver beat the pants off of gold because the spread broke out. We're watching the top, that green line. If you break that out over 1.31%, we expect a massive rapid surge up to at least the norm of 2%. Well, even right now, if gold just sat here at $4,000, it's 4,200 actually. Do 2% of that's $80 silver. Okay, but gold isn't going to sit still. And again, what if gold, as we showed on the very first chart, does another equal ratio scale bull trend move that it did in 75 to 80 and 2001 to 2011, an eightfold move? That means gold's at 8,000 plus. Could do it fairly quickly too. If silver were 2% of that, it's $160 silver. And again, 2% is normal. In fact, in bull market years, 79 to 80, or in 2010 to 11, the silver gold ratio, as we measure it, percent versus percent, it was at 3.5%. And in 79 to 80 was 6%. So we could get a major explosion, not only in this spread, but it would indicate to us that the price action of silver is now going to go more vertical than you can imagine.
Okay, I'm going to bring up a little bit of a longer one here. And so this is basically what you're talking about. So this is silver divided by gold. And so back here in 78, we can see that the ratio was 0.025, which basically means that, two and
It
a
was
half
two and a half
percent.
percent. Yeah, yeah.
Yeah.
And it shot up there to 8% at one time. This must be weekly or something, but
Yeah.
or daily.
This is
Yeah.
monthly
Yeah.
actually. So we got
Okay.
up to like 6,
Yeah.
7%.
Yeah, that was a
And then
bull year for the metals. Yeah. Uh-huh.
this is kind of what you're expecting, something like
Yeah.
this, a re-rating of the ratio,
Yeah.
which would, the only way to really explain
Well, I
that is
mean,
that silver just,
even just to go back to the high in 2011, which was, about 3.5 there.
okay, right here. Yeah,
That's enormous.
that is
Even if
enormous.
gold just sat still and silver went to 3.5%, it would go off the page. We're arguing now. There's another set of charts that sort of smack you in the face and make the point. It's the base metal charts I sent you. You could stay on this chart for a minute,
Okay.
but draw a line at 2%. Drop your line down to 2. Look how
2,
many
okay.
times it's been at 2%. It's hardly abnormal.
Oh, yeah.
Yeah, it's no big deal. So
That's
if we
kind of
come
the
up, yeah,
average.
and you could already see the spread since 2000. There's like a downtrend too on that spread at the last couple of years, and
Yeah,
you're starting to approach that. So you could easily go to 2% just as, hey, big deal.
yeah,
Well, that's off the page, even at current prices, in terms
yeah,
of where is silver price versus gold. Uh, and if we're in a bull trend, so if we match the bull trends, we could go to 3 plus.
yeah,
And you did it quickly. You didn't do it in an arm wrestling manner. You did it in a thunderbolt
yeah,
both
yeah.
times.
These are parabolic, violent moves that happen in 6
Not
months
only,
and
yeah,
they're over.
not only in the spread, but in the price of silver as well. So, yeah, and this is not unusual, by the way. Silver has made a grand mistake. It's what we're arguing. Markets make errors. Anybody who's been in markets long enough knows that, hey, that dot-com top, that was an error. It went too far, too long, and therefore it broke. NASDAQ dropped 82% in the next 2 years. 82% after that bubble broke. Because it was why? Nothing wrong with the truth of the internet. It changed their lives. But they overpriced it too quick and it burst. Okay. Now ultimately it proved itself, but it had went down 82%. Okay. The same thing happens at lows sometimes. Sometimes a market will go low, abnormally low, irrationally low, and stay there. And everybody says, see what a dog, I'm not interested in that market. Just leave it alone. Don't step on it. And when it wakes up in a way that is like a sudden jolt. Like, what am I doing down here? Flip to those charts, if you would, of the copper and lead, I think what it was.
Okay,
They make
right.
the point. So it's a reality that
Here's
people need to
copper,
realize.
and this is going back to the
Yeah.
early 90s until present.
Yeah, you can in fact take that lower range you see in the 90s up to 2000. It goes back into the 80s as well. This is a Federal Reserve chart of the price of copper, by the way,
Okay.
from St. Louis Fed. I guess monthly closes or something. But anyway, you lived in a range, okay, for decades. In fact, it goes back to the 1980s. But look what happened when you came out of the range.
Yeah.
You tripled. You went from 3 to 8 to almost 9,000. You've almost tripled in price. But the first doubling was a matter of a handful of months.
Yeah.
And this, by the way, was not correlated to gold and silver at that time. They had their massive move later on in that trend. Okay, so the copper did it on its own. And then look what happened after that. Yeah, you had a big drop, but look, you live in a new range now.
Yeah. Yeah. This is
Now
the
it's
new
suddenly
home.
it's a range that if you take the middle of that, about 7,500, that's still double and a half what it lived in between the 1980s and 2004. A new
Yep.
reality is what I'm saying. And it did it quickly. And
Yeah.
right now, by the way, copper's trying to break out of that thing again. And by the way, copper right now is trading well above its 2011 price high. It's not real clear on this chart, but when you look at a monthly futures, you can see it's above it. Drop down to the next chart, a very exciting market called lead. Again, you could go back to the 1980s and you lived in this dull up down range, just like silver's been in for 50 years. And that was its reality. And then when you came out of that reality, see the red ellipse? You went from 1200 to 3600 in a handful of months. And by the way, this is not coincident with that copper move. This is a year later. So it
Okay.
wasn't the same time. So it was peculiar to lead. But it went into a new reality. Oh, yeah, it had a sharp sell-off after that. That's not the issue. The issue is, but look at the new reality that prevailed since then. Double to triple the price of the old reality.
Yeah.
If silver did this, you could go like the $200+ and then level off into a new reality that's just say 100 to 250 or something.
Yeah.
Okay.
Yeah.
So what we're arguing in answer to his question, there are so many fundamentals out there that are huge involving the failure of fiat currencies in terms of distorting reality, creating monetary inflation, therefore price inflation of assets like lead price. I could have shown you a bread price chart or a beef price chart. Look the same as this. A new reality. All distorted by the money unit that you showed, the M2 chart. Silver has not done so. We're arguing its time is now, and it is likely to do it very rapidly in a way that just jolts people. So if you're not already there, don't come back in 6 months. Okay. It's not the time to be joining. You were going into a new price reality, and I think likely fiat currencies will be questioned by large governments in this next debt crisis, to where are already some major governments around the world are pondering seriously moving to gold-backed currencies. We know that. And the Western world and Japan included could be the laggards in suddenly realizing, hey, this 100-year game hasn't been working. We need to get something more stable. But you got to go through a crisis sometimes to create that change in thought. And I think gold and silver know that's coming.
Yeah, the paradigm shift. Um, Leveraged wants to know. He's talking a lot about how I hear a lot about how the price of silver is wrong, and he's asking, is there any other asset on the planet that is priced as wrong as silver?
No, not that I could think of right now. No, even the price of bread or beef. Go to the Federal Reserve site, type in price of bread, price of uh, beef, 1 pound of beef. They'll show you a chart just like those. And then get an M2 chart and look at it. And then go back and calculate, let's say 25 years ago, where M2 was and where it is now. Do the math and look at bread, look at beef, look at the copper, look at the lead. Silver's lagged that. I mean, if silver were $50 in 1980 and $50 in 2011, which is still a long time ago, a decade and a half, okay? The decay in the money unit is like 90% doubling in the quantity of money every decade, okay? Silver's way lagged to that reality, and it has the other virtue. Yes, it's industrial, but it primarily moves as a money unit. It has been money for 3,000 years as well. And I think there's a new awakening among people who are watching gold saying, silver's also a monetary metal. Go back 3,000 years. In fact, it was a monetary metal in the US one time. Okay. Uh, a new reality is coming, and silver has definitely made a mistake. And I think when it blows its cork, it's going to blow its cork.
Okay, I'm going to share my screen here, and we have a question on ratios, and it is the ratio of platinum to gold. Aaron wants to know, historically, platinum is extremely cheap compared to gold. Do you
Mhm.
think the platinum to gold ratio will revert closer to the historical mean in this commodity bull market?
Well,
It's,
first off, we watch, and I've measured platinum, and there have been times where people think platinum is linked to gold. It is not. Okay. Its long-term correlations are with the Bloomberg Commodity Index. It moves like a commodity. Uh, if you'll look at what happened to platinum over the last few years, while gold, we'll go back to 2015, for example, on that chart, right about there, it was about, what do you got, $900 or something there in 2015.
2015
Yeah, right. Okay.
is
Yeah,
right around
right
here.
there. Just stop there. Okay.
Okay.
Gold has doubled in a half since then. Is platinum linked to gold? No, of course not. But okay,
Good
no.
point.
The Bloomberg Commodity Index has also been going down from 2015 through 2020. Now, platinum made lower lows here recently, but Bloomberg didn't. But platinum moves in waves, more like the Bloomberg Commodity Index, meaning grouped with like wheat, uh, base metals, energy prices. They all tend to move together with the Bloomberg Commodity Index as a category. Sometimes that category, and it's rare, late 70s is one example. Uh, 2007 to 8 was another example. Gold was going up, but then the commodities peaked at 8 and went down despite gold continuing up. So there was no correlation there. And you see platinum did not continue up through 2011. By 2011, it had already collapsed while gold continued up. So it's not a good correlation. And yeah, you might get a rebound here in the ratio, but don't think it is a monetary metal. We never use the word precious metals with gold and silver at MSA. They're monetary metals, and it's a distinct difference. Palladium and platinum are precious metals, but they move like the commodity category. Recently, our annual momentum of platinum and palladium has said, okay, back into positive mode. But that doesn't mean they're rivaling gold. It just means they're back into a positive trend. Definitely lagged to gold, not just in discounted to price, but in the trend direction. They've not been in sync with gold since a long time. So don't try to treat it as a sister metal of gold. Yes,
Okay.
it's in a bull trend now. We think it's turning up and it's valid and it'll go higher. But, and maybe it goes up at the bottom end of that range there. I don't know. That's not really the issue because it is not a money unit.
Okay. Okay. Yeah, I've been thinking of this one in the form of ratios, but you're kind of saying that, you're kind of comparing apples and oranges because gold is money and platinum's more of an industrial metal. And
You could show a corn chart and say the same thing.
okay.
Is corn get back to its regular value to go? Well, yeah, corn could go up when the commodity index turns up, and it's on the edge of that right now. Bloomberg is about a point below a major breakout level for us. It's not there, so we're not counting it yet. And by the way, breakout, I mean a secondary move up because we had a big move between 2020 and 2022. And then when that war began, commodities peaked and went down. By the way, the war did not cause the commodity rally. But I think that Bloomberg is ready to perhaps coattail gold. This is what happened in the late 70s. Gold made a low in 76 and turned up and went through 1980. In 77, a year after gold had made its low and turned up, the Bloomberg Commodity Index, or the CRB back then, lagged to gold and turned up also
Hmm.
and finally joined it. But it wasn't in sync, it was lagged to gold. So we could have a situation where, stock markets, especially the bloated ones, go down, economy turns negative, and commodities decide to join gold. Don't expect commodities to weaken if the economy weakens. There are plenty of examples. 2007 and 8, for example, where they were booming and stocks were topping, or 2000, 2002, or late 70s to 1980, we had a global economic recession, and yet commodities boomed on the coattail of gold. So they technically look like when the asset class shifts out of stocks, that's a lot of money,
Yeah.
and goes to a new place, they're also going to find out that commodities are dirt cheap relative to like 2008 or 2011 prices. Bloomberg right now is 105. You know where it was in 2008? 270. Was it,
Okay.
no, 238, I think it was. So it's less than half the price that Bloomberg was in 2007, 8.
Yeah.
Okay, so
Yeah.
it's not expensive and it's clearly stabilized.
Yeah.
And after that zoom from the 2020 low where it said, I'm out of here. Okay, that was leg one. I think leg two could start soon.
Okay.
Um, and therefore, things like platinum, which is now in a leadership position within the commodity complex, it's much stronger than Bloomberg, for example, lately. But that complex could turn up and investors could say, hey, that seems to be working. Let's buy some stocks that mine platinum, or mine copper, mine lead, or produce fertilizer,
Yes. Um, okay, some wrap up questions here. We're going to do a little deep dive on silver backwardation and oil in the premium version. So, premium subscribers, stay tuned for that. Wrapping up here, basically, Jovan and Goose are asking kind of a similar question here. So, in the event of a severe market downturn, what do you see happening with precious metals? Is there going to be a sell-off? What do you see happening with the miners? If your forecast for the S&P and NASDAQ is kind of topping out, could we see a pretty good correction here in the metals and miners?
Take a recent example. Yes, there is a month back in October of 2008, a full year into a bear trend on the stock market. Gold finally said, oops, I think I'm going to have a correction. Happened to be coincident. It was a very bad month. Gold went from 1,000 area or 900 area down to the upper 600s quickly, mostly over in that month. And within a handful of months was back to its high at 1,000. During that same time, stock market continued down. But there was a crash month in October 2008. That is what's on everybody's mind.
Okay, this one right here.
Yeah, it was this quick drop. Well, the stock market dropped into March of 2009, continued on down after that gold break. Gold went back to its high very rapidly within about 4 or 5 months. By the way, that's when they instituted QEs. October of 2008, when the stock market puked, Bernanke said it will take a page out of the Japanese book. What benefited? Gold exploded back to its high. Stock market kept going down. Okay. Now, recently, we have a beautiful example. Get a chart of gold and look what happened from January to April.
January to April of this year?
This year.
Oh, okay. Let me go to the daily chart so we can zoom in a little
Look
bit
at that,
more.
or weekly would be fine.
January
This year.
This year. Okay, right around here.
Yeah, is this 2025?
2025, January.
Yeah, okay. Yeah. Okay. And then you went up into April.
Into April. Okay. Yeah.
Okay. Now, what happened to the stock market during that time? It was getting heck kicked out. It lost 20%. Right? Okay.
Yeah. It came down with the Liberation Day.
Huge move. Huge move down. Gold said, I don't care. Silver also went up during that time. Okay. So, and gold doesn't care so much about the stock market. Yeah, there's sometimes it'll be going up with it or not. But really, what gold cares about is central banks destroying money. As I said, go back 25 years, invest in gold or invest in the S&P. You broke even on the S&P in terms of real dollar value. In other words, if you bought S&P and sold it now, you could buy the same amount of loaves of bread, okay? As you could have in 20. Okay. The same number of pounds of lead, okay? Gold went up 16-fold during that time. Okay. The decay in the money unit is what gold drives, what drives it. Silver as well. Silver's a baby of gold, and it ultimately will catch up to it and probably surpass it in the next 6 months in a way that will shock people in terms of performance. It's the ongoing decay in the value of money, central banks destroying money, central governments destroying money by spending, borrowing, not being able to afford it. And now we have a woman, for example, who's reflecting Trump. In fact, she said she's sort of a Trumper in Japan, elected prime minister. What they call a far righter in Japan, supposedly a free market advocate, right? They have a huge debt problem. They don't have enough young people to pay for the obligations the government's made for the older people. Okay, demographic problem. Okay, she said we're going to print. Okay, what? And you're on the free market side, and you don't want government to inflate? And Trump wants the Fed to cut rates to zero if need be, or to 1% anyway, and print if you need to. Who's defending the integrity of the money unit? Nobody. Neither side of the spectrum, here or in Japan. You got a monetary crisis coming because you got government debt that's going to blow up. Okay, and if that happens, they can't allow that. They'll go nuts. They have no choice but to go nuts on printing. And that's when suddenly, if you go into that type of financial fiscal crisis, especially when the stock market starts to hurt people and create emotion, that's when academicians, politicians get pressure that suddenly, hey, this game hasn't been working. We're trying to do it again by printing more QEs, et cetera, et cetera. All we're doing is destroying the money unit. And that brings up, another question. Look at a Venezuelan stock market chart. You don't have to do it here. It's vertical. It's a beautiful thing. I don't know why we're all not invested in Venezuela. Okay. It's gone parabolic. Has it really? No, not in real terms. It's money degradation. And it's a Weimar Republic situation. Are we going to do that? I don't think we'll make it to that point. I think we're going to bust and do it the other way. But God forbid they should ever go that crazy and turn us all into, then it won't matter whether your stock market's going up. Loaf of bread's going up more, day by day, week by week. Price of gasoline will go through the roof. Nothing to do with how much they're putting out, Okay, so the monetary issue is what drives gold and silver. And right now, if you do break the stock bubble and create data points, the Fed's going to go nuts.
Okay. So there was a little blip in there of the Trump Liberation Day in gold, but nothing compared to what the stock market did, and you kind of see a similar.
Yeah, I don't. And also, I'm not sure the stock market's going to crash. Crashes are unusual. In fact, in 2008, it took a full year of major decline before you ever had what you could call a crash event. That's 30% or more in a short period of a couple of weeks. Okay, 29, there was a crash. But 2000 to 2002, bear market, major 82% collapse in the NASDAQ, 50% in the S&P. No crashes, major destruction. And had it not been for October 2008, it wouldn't have been a crash in that bear market. Major move was mostly non-crash. So being fearful of that event, I don't think is a good idea. And right now, I made the point about silver. I make the point equally about gold miners and silver miners. They're vastly undervalued to gold, and I think they're going to outperform gold handily over the next handful of months, especially over the next year or so. As gold continues up, probably more parabolically, the miners will go vertical. And we'll look what's happened this year, for example. I don't know the exact numbers, but GDX has beaten gold and has certainly beaten the S&P in terms of percent gain. It's gone up in ways that people said, I can't believe it,
It's good to own the miners. Okay, we're going to do another deep dive in that here in the Premium Substack. Michael, if people want to get a hold of you and follow your work, how can they do so?
It's olivermsa.com. Take your time, tool around the site. We explain our rather unorthodox methodology, and take your time.
Okay. Well, thank you, Michael. I get your newsletter, and I like it a lot. I read every email, and I appreciate your work.
Thanks, Steve.
Thank you for tuning in today. If you enjoyed this conversation, we went even deeper in a special interview exclusively for Premium Substack subscribers. Michael and I talk about how to maximize this next move in silver, his price level to watch for a breakout in WTI oil, and what price points he's watching like a hawk for a breakdown in Bitcoin. If you want access to that, plus weekly updates on the stocks I'm buying and selling with real-time trade alerts, head over to Substack and join us. The link is down below in the description, or go to stevebartonmoney.com/newsletter and sign up there. And if you're already a premium subscriber, check your inbox. The next video with Michael is waiting for you. Thank you so much for your support. Have a wonderful rest of your day.